Hi, I'm Cynthia Murphy, Head of Workforce Solutions at CEI. I also lead the Childcare Business Lab, which is a CEI program designed to help childcare providers make better business decisions and improve their profitability. Today, we're talking about the Employee Retention Tax Credit. And if you can take advantage of this in 2020, you will definitely improve your profitability. So let's take a look at some of the details. If you have experienced a significant decline in gross receipts in 2020 compared to 2019, and you're paying workers, there's a high likelihood that you're eligible for the Employee Retention Tax Credit. So let's dive in here. First, let's talk about gross receipts. This is the IRS term for what you might think of as the fees that you charge parents, or you might refer to this as revenue before expenses, or some of you might call this your billables. So what you need to do is to look at each calendar quarter. So let's take the second quarter, for example, which would be April, May, and June of 2020. You look at your gross receipts and compare that to the same 3 months in 2019. If your gross receipts in 2020 are at least 50% worse than 2019, and you're paying workers, then you're eligible to receive a tax credit for up to 50% of what you're paying the workers. You remain eligible for the tax credit until your gross receipts reach 80% of the prior year calendar quarter. Let's talk through an example. Let's say that in the middle of March, when Governor Mills issued her executive order to stay at home, you closed your child care center. And let's say that you had 5 workers. You laid all 5 workers off, and you opened up again in June. You had fewer children, and so you brought back 1 worker. This is the second quarter, so the wages that you pay that 1 worker would be qualified wages in this situation. You take a look at your gross receipts for those 3 months, April, May, and June of 2020, compared to 2019. And if you were truly closed for April and May, there's a really high likelihood that your gross receipts will be more than 50% worse in 2020 than 2019. Let's fast forward to the third quarter. Maybe you bring on 2 more workers, and maybe you bring them on in August. So you take a look at the third quarter gross receipts. That would be July, August, and September. And you compare that to 2019. And as long as your 2020 gross receipts for the third quarter are less than 80% of the same quarter 2019, you remain eligible for the Employee Retention Tax Credit. But in the third quarter, you earn that credit for all 3 workers. Same thing holds true for the fourth quarter. Both for-profit and non-profit childcare providers are eligible for the Employee Retention Tax Credit. There are only a couple of situations where you wouldn't be eligible. The first, if you're self-employed, while your wages are not covered, any wages you pay your workers are covered by this tax credit. If you have taken a Paycheck Protection Program loan, you're not eligible for the Employee Retention Tax Credit. But everybody else is eligible. Let's take a look at the right-hand side of the screen and talk through a bit more detail about what this tax credit really means. So you earn a tax credit for 50% of qualified wages. Qualified wages hinges on the number of employees you have. And here in Maine, the first bullet covers all of our childcare providers, if you have fewer than 100 employees, wages you pay to every employee are considered qualified. Second thing to know here is that you earn 50% up to $10,000 in wages, which means that the maximum tax credit that you can earn for each worker who you're paying is $5,000. That's a pretty good number to think that you can earn $5,000 in tax credits for every worker who you're keeping employed while you are seeing this significant decline in gross receipts. Well, your next question is, how easy is this to get back? I have to tell you that the IRS has made this super simple. If you have workers today, you know that you are filing the IRS Form 941 on a quarterly basis, or perhaps your accountant is filing it for you or your bookkeeper. You use that very same form that you're using today to file Social Security tax information to record your request for the Employee Retention Tax Credit. So no new forms. Same old 941. You just tack on the request for the Employee Retention Tax Credit. The IRS has made this even better, though, because if you find yourself in the situation where your credit is greater than the taxes that you owe, you can file a new form, 7200, to request a refund immediately. You can also request an advance on the Employee Retention Tax Credit by using Form 7200. The objective here is to put money back in your bank accounts as quickly as possible, which is why the IRS has made this relatively easy. Well, I'm sure you have many questions, and so I've put together what I think are a set of resources that you may want to take a look at. If I've piqued your curiosity and you just want to know a little bit more before you call your accountant or your bookkeeper, take a look at this first FAQ that the IRS has put together. It's a relatively quick read, and you get a very good sense of some of the detail behind what I've spoken about today. If you're the kind of person who likes to know the nuts and bolts about the tax credit, the second FAQ has your name on it. And if you have a situation that you think is unusual or unique, take a look at that third FAQ, which describes a whole lot of employer eligibility scenarios. I bet when you take a look, you'll find one that mirrors your situation. If you do file your own taxes, I've given you the links to Form 941 and also to Form 7200, along with some tips to help you complete the form. Well, I hope that the Employee Retention Tax Credit is applicable to you and your business, because if you can get back up to $5,000 that you have paid out in employee wages, that will definitely improve your profitability in 2020. Thank you so much for joining me today.